Hello friends, this is our 15th video lecture and it will be about IAS 40 investment property. Definition of investment property. Investment property is property held to earn rentals or for capital appreciation or both. That could be land or building or part of a building or both land and building. Remember that property may also be classified as inventory. This will be the case if it is held for sale in the ordinary course of business, such as residential property held by a developer. Examples of investment property. IAS 40 gives next examples of land and buildings which should be classified as investment property. Land held for long-term capital appreciation, land held for a currently undetermined future use, building leased out under an operating lease, vacant building held to be leased out under an operating lease, property that is being constructed or developed for future use as investment property. IAS 40 also gives examples of land and buildings which shouldn't be considered as investment property or shouldn't be classified as investment property. Property held for use, that's, for example, property held for use in the production or supply of goods or services or for administrative purposes. Owner-occupied property, including property held for future use as owner-occupied property, property held for future development and subsequent use as owner-occupied property, property occupied by employees, and owner-occupied property awaiting disposal, property held for sale in the ordinary course of business or in the process of construction or development of such sale, property being constructed or developed on behalf of third parties also shouldn't be classified as investment property, and the last one, property leased to another entity under a finance lease. So these are examples of property that shouldn't be classified as investment property. Specific rules. There are specific rules for the property with dual uses. If the portions of the property can be sold or leased out separately, then the part that is rented out is accounted as investment property, and the other part is accounted as an item of property, plant and equipment. If the portions of the property cannot be sold or leased separately, then the property is treated as investment property only if the owner-occupied portion is deemed insignificant. Keep in mind, the same property may be classified differently in financial statements drawn up at a group and individual company levels. So it could be such situations when in group consolidated financial statements the item of property classified as investment property, and in individual company level separate, for example, in separate financial statements of a group company, there could be classified, such item could be classified as property, plant and equipment. Measurement at initial recognition. IAS 40 requires items of investment property to be initially measured at cost. If it is purchased, then cost, if the item of investment property is purchased, then cost relates to the purchase price as well as any directly attributable expenditures, professional fees, taxes payable but non-recoverable taxes, other transaction costs. If the item of property is self-constructed, then cost equals to all costs incurred until the asset has reached a condition necessary for it to be capable of operating in the manner intended by management. In other words, when it was ready for use. Companies need to select between cost model and fair value model and apply it consistently across their entire investment property portfolio. The cost model. Under the cost model, the current amount of the asset is determined as its cost less any accumulated depreciation and less any accumulated impairment losses. If a company chooses to account for its investment property portfolio under the cost approach, it needs to disclose the fair value of its investment properties in the notes to the financial statements. Fair value model. Under this approach, the asset is carried at its fair value, with any gains or losses arising from changes in fair value being taken to the relevant period's profit or loss. In case of fair value model, no depreciation is charged, and also no review for any impairment. If the company is unable to reliably measure the property's fair value, that a specific asset will be accounted for under the cost model. IFRS 13 defines the fair value of an asset as the price that would be received to sell the asset in an orderly transaction between market participants and the measurement date. IAS 40 discourages changes from the fair value model to the cost model, because it is highly unlikely that such change would result in a more relevant presentation of the company's financial position. So, keep in mind that under fair value model that there is no depreciation and there is no review for any impairment. The fair value by itself is reviewed, and any gain or loss on fair value is recognized. So, transfers from property, plant and equipment to investment property. If the cost model is applied, then the asset is simply transferred at its current carrying amount. So, and if the fair value model is applied, then the asset must first be revalued using the rules set out in IAS 16, and then the actual transfer to investment property is made. There is no immediate gain to be recognized in profit or loss from moving an asset from property, plant and equipment and into investment property. Transfers from investment property to property, plant and equipment. If the cost model is applied, then the asset is transferred into property, plant and equipment at its current carrying amount. If the fair value or model is applied, then the asset's fair value is first updated using the rules in IAS 40. Any gain or loss going to profit or loss. Subsequently, the asset is transferred into property, plant and equipment at fair value. So let's look through a simple example to clarify this standard a little bit. So our entity Fluffy Kitten owns a building which is used as a head office. At 1st January 2017, it has a carrying value of 10 million and its remaining useful life was 10 years. On 1st July 2017, cheaper premises were found to use as head office. Fluffy Kitten management decided to lease the property under an operating lease. The building was valued by a qualified expert who assessed the building's value at 11 million as at 1st July 2017. and at 12 million as at 31st December 2017. Please explain how should we treat this building in financial statement as at 31st December 2017. So, first of all, period from 1st January till 30th June 2017. Fluffy Kitten should treat building during this period as property, plant and equipment under IAS 16. The building must be depreciated. So, why from 1st January 2017 till 30th June? Because on 1st July 2017 cheaper premises were found, and there was a decision to lease the property under an operating lease. So we need to accrue depreciation for a 6 months period. So we take our carrying value divided by our useful life, remaining useful life of 10 years, and multiply it by 6 months to adjust for a 6 months period, and divide by 12 months. And we receive, just look here please, 10 million carrying value. We divide it by 10 years and multiply by 6 months and divide by 12 months. So we receive a depreciation for the whole year, but we when we divide 10 million by 10 years, we receive 1 million. But that's a depreciation for the whole year, and we need only 6 months of this year. That's why we multiply by 6 and divide by 12, and receive a depreciation of $0.5 million. Carrying value as at 30th June 2017 will be 10 million minus depreciation of 0.5 million will be $9.5 million. 1st July 2017. The building must be revalued to its fair value. Hence, 11 million minus 9.5 million gives us 1.5 million and it is a revaluation gain. Why it happens in such a way? Because we know that qualified expert assessed building at 11 million at 1st July 2017. So that is why here 11 minus carrying amount of 9.5 million gives us 1.5 million as a revaluation gain. This revaluation gain must be reflected through other comprehensive income. Starting from 1st July 2017, the building is classified as investment property because we know that decision was made to lease the property under an operating lease. So it is in line with the definition of investment property. As at 31st December 2017, the building must be revalued to its fair value of 12 million, recognizing gain of 1 million through profit or loss. Why 1 million here? Because we have our fair value at 1st July. We also increase our value of the asset to 11 million, and we know that at 31st December the value of the asset was 12 million, so 12 minus 11 gives us $1 million. That's gain on fair value, and it must be recognized through profit or loss. So that is the end of our lecture number 15. Thank you very much for watching. I hope that this video was useful, and see you soon.